What's the minimum amount to get started in an IUL, Indexed Universal Life Insurance contract? Well, sometimes I say that's the wrong question. You may want to be asking what's the maximum amount, but on this channel, I have a lot of examples of my favorite financial vehicle for long-term goals, a properly structured, max-funded, indexed universal life. And I'm using examples where people are putting in $100,000 a year, sometimes $1 million a year, $10 million a year, because the affluent love these. So it intimidates some people. And so the next question is, well, what's the minimum amount? Well, in actuality, you ought to be able to sock away, I think, at least $500 a month. You could set one up for $500 a month if you're in your 30s or 40s. If you're in your 20s, yeah, you could set one up for $300 a month. My wife and I, when we had our 6 children, we set them up for as little as $100 a month in a savings when our children were born, okay? And so it all depends on the age, but I would recommend, generally speaking, if this is for you and you are middle-aged in your 30s or 40s, I would recommend that you have at least $500 a month that you could comfortably set aside in order to set up a max-funded IUL. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. If you've watched very many episodes on this channel, my favorite financial vehicle, without question, is a properly structured, max-funded IUL for any long-term goals. Now, IUL is Indexed Universal Life. Unfortunately, I would say more than 99% of IUL insurance agents in America do not understand how to properly structure a max-funded IUL. Now, I am usually using illustrations on this channel showing my sort of sweet spot of clients, which are 55-year-olds to 75-year-olds. So right off the bat, you probably, when I said that, said, you mean you use these for older people? Because the first thing that a lot of people think is that they're too old if they're 55, 60, 65 years old. Absolutely not. I would say that over 90% of all the clients that I've ever helped are people 55 to 75 up to 79, 80 years old. And when you understand how to structure them properly and take the minimum amount of insurance that you can get away with under IRS guidelines, TEFRA, DEFRA, and TAMRA, it doesn't matter how old you are or how unhealthy you are. Did you hear that? Okay. Because these tax citations allow you to squeeze down the death benefit so that it doesn't matter if you're a 22-year-old athletic marathon running female, or if you're a 60-year-old, or if you are a 78-year-old. I'm thinking of a friend of our family who took out one at age 78, and he had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters all predeceased him, and 3 brothers that predeceased him. And he was rated table D. If you don't know what that is, that's 100%. He had to pay twice as much for the insurance as a normal 78-year-old. In other words, he had a life expectancy of an 83-year-old. But we got him approved. And because of that, I was able to squeeze down the death benefit. I got away with less death benefit for him than I did for a healthy 78-year-old, and way less than a 22-year-old, so that when he put in his $500,000, his goal was to get the best net internal rate of return and have the cost of the insurance be the cheapest. The cost of insurance for him at an actual age of 83 life expectancy for an 83-year-old was no more cost for the insurance as a 22-year-old athletic marathon running female. Why? Because the amount of insurance that I could get away with was way less than a healthy 78-year-old or a 60-year-old or a 22-year-old. There's a lot of agents that do not understand this. Now, when I start throwing out these examples of people putting in $100,000 a year, I use those as round numbers so that people can extrapolate, okay? So that when I talk about $100,000 a year and it grows to $1 million, and $1 million can generate $100,000 a year of tax-free income that you can extrapolate from my examples, so that every million that you might accumulate by the age that you want to retire, in an illustration, you can say, oh, I have, 2.5 million at age 65 or 67 or age 72 or whatever. And so how much could I take out without running out of money if I live to be 120? Well, at a 10% payout, okay, if a million can generate 100,000, 2.5 million can generate 250 grand. You're extrapolating in your head. That's why I use examples like 100,000 and a million, because they're real life examples, but it's easy to extrapolate. But the first question is, people get a little bit intimidated. Well, golly, you mean I can only start out with if I have it like 100 grand a year or $1 million or whatever, because I'm using that example. I go, no. So the next question out of their mouth is, well, what's the minimum amount to get started? They think I'm going to say, well, you need 10,000 or 25,000 or something. No. You can set one up for $500 a month. You don't even need any lump sums to put in there, even though that helps sort of kickstart it. If you're just going to be socking away a monthly amount of savings in lieu of doing that in IRAs or 401ks or some other savings or investment account, because you realize a properly structured max funded IUL will pass the liquidity test, safety test, and rate of return test with flying colors, and is totally tax-free. There's no other financial vehicle in the Internal Revenue Code that allows you to accumulate your money totally income tax-free, okay? You can access that money, and you don't have to wait till you're 59 and a half to do that, and it's totally tax-free. And at the end of the day, when you pass away, anything you leave behind in the IUL policy will transfer tax-free, and it usually blossoms, it increases in value, meaning I'm just about 72 right now. If I died in an accident tomorrow, every million that I would leave behind in an IUL would double to about 2 million and transfer income tax-free when I die. There's not an IRA or 401k or a Roth IRA or 401k that would do that. And people naturally say, well, how much does that cost? Well, nothing's free, but it didn't cost me anything. It's coming along for the ride with a portion, a minuscule portion of money or cost that people would shell out in unnecessary tax. So it doesn't cost me anything. It's not free, but it's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax if I followed the herd and put my money in IRAs and 401ks, okay? And so when people ask the question, well, what's the minimum amount? Well, if you're in your mid, 30s, for example, and you don't have any lump sums, I'd say, well, you probably shouldn't be setting one up unless you have at least $500 a month of discretionary dollars income that you could allocate to an IUL. And if you set one up to accommodate just $500 a month, that's $6,000 a year. You don't have to put in $500 a month. You could back off and put in just $100 a month, even $50 a month, especially if you started out putting in $500 a month for the first year or two. You could actually stop and coast for a couple of years. And so you have a lot of flexibility, but I would probably recommend that you wait until you can at least sock away $500 a month if you're middle-aged. Now, if you're, just graduating from college and you're, in your early 20s, you could set one up for $200 or $300 a month. My wife and I, we had 6 children. When each of them were born, we set up IUL policies for $100 a month, okay? And we could put in as little as $25 a month into their little policies, okay? And so it's not so much the minimum, it's not what you begin with that counts, it's what you end up with. And so most of the time when I say, well, you can set one up for $500 a month, they go, oh, well, I'm okay. Then I really want to set aside more like $1,000 a month or $2,000 a month or what have you, in lieu of putting money into an IRA or 401k because they realize this is better. Or maybe the overage. Many people, they might have a 401k at work and they're putting in 10 or 12% or whatever. They're only being matched on the first 6%. Yeah, I would strongly recommend, this should be a no-brainer, that you reposition the money you're putting in over and above what you're being matched on by your employer in a 401k. And if that 401k is not performing very well, many people come to the realization it'd be better to actually not even participate in some of those 401ks because they're not managed very well. So it doesn't do you a lot of good to get a match. The match is basically your employer is covering the future tax on that liability. You put in $1, they match 50 cents on that. You're not getting a 50% rate of return. That's what people think. You're just starting out with 50% more. And if you were immediately vested and you pulled out $1.50, you would pay 50 cents on that tax. The employer is covering the tax liability on that, okay? And the growth on that is also belongs to the government. So it's okay, but anything you're not being matched on, I would probably reposition into an IUL. So the minimum amount is small. You could set up an IUL for a few $100 a month, but it's really looking at assets that are underperforming or non-performing. When I start asking people how much they're socking away for their kids' college funding, like a 529 plan, and they realize this is way better than a 529 plan, because a 529 plan can only be used for college. What if your child or grandchild gets a scholarship and they don't need it? They don't need that money out of the 529 for that. They want it to start a business or to use as a down payment on a home. Now they have to pay tax. In an IUL, you don't. If you happen to pass away while you're saving for college for your child or grandchild, it doesn't blossom. An IUL, it blossoms. You're sucking away money, you die, it pays out a larger amount in a tax-free death benefit. Why would you mess around with a 529 plan is what I'm saying when a property structured IUL has the benefits of a 529 and a whole bunch more without all the strings attached. The same is true as compared to IRAs or 401ks or Roths or working capital for business or emergency funds. Because this is where banks and credit unions put 30 to 40% of their tier one assets for liquidity and safety is in insurance companies, okay? Oftentimes in BOLI, bank-owned life insurance. So when people say, what's the minimum? They're a little bit surprised when I say, oh, you can set one up just for $500 a month. But I'd recommend you actually look at all of your assets that you're allocating to different financial goals and look at the ones that are underperforming or non-performing, meaning they don't pass liquidity test. You can't access it when you need it. You could lose your principal. It doesn't pass the safety test. The rate of return, you're rowing upstream at the rate of 2 or 3 miles an hour in a bank, and the current of inflation is coming down at 7, okay? The rate of return test is not being passed. Any of those assets that are underperforming or non-performing, you optimize them by repositioning them into an IUL, and now you're going to be ending up with far more than the minimum. But now you know the answer. If you don't have any assets to reallocate, to optimize, then you can start just socking away a monthly amount into it based upon your age, and it's usually a few $100s a month to get one started. And again, you take the least amount of insurance you can get away with. If you do that, $500 a month. If you do that for a year or two, I mean, you could hold off for a year or two and not put anything in. It would behoove you to put money in if you have it, but you don't have to. That sort of gives you a cushion. And you could back off and put in just $100 a month instead of $500 a month for years if you wanted to. So I love the flexibility of max funded IUL. Now, if you want to learn more and see examples, I would strongly recommend that you study and read my most recent best-selling book. It's flying off of our warehouse shelves. It's called The Laser Fund, okay? And it's actually 2 books in one. This side is about 200 pages with 14 chapters with all the charts and graphs, explanations for the left brain learner. If you're more of a right brain learner, you just simply flip it over to this book. This is about 100 pages, 12 chapters with 62 actual client examples. If you want to use your whole brain, left brain and right brain, I would read this entire book, okay? Now, you simply click on the link below or go to laserfund.com and you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. I'll cover the rest of that cost. I will fire out a hard copy of this book to you via priority mail. Now, when you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's options for that. You can even schedule to attend an educational webinar, a 90-minute webinar perhaps, or even a 6-hour Retire by Design experience. Those are free, and you can register, but you can even schedule an appointment while you're in there with an IUL specialist that will help you understand and see illustrations of how a property structured max funded IUL can work in your particular set of circumstances. And there's no cost or obligation, because if you don't set it up right, you're going to kick yourself down the road. And that's why I feel it's so critical that you see examples of IUL that is structured correctly and funded properly. And that's why I created a whole network of professional advisors called IUL Insiders. So claim your free copy of the Laser Fund, and if you're an advisor, you can also check out IULinsiders.com so that you can understand some of these dynamic questions that I'm talking about right now.